The COB is brought to you by Pepperstone, trusted by traders in over 160 countries. From Barangaroo Studios, here's what you need to know about the day in business and finance.
G'day and welcome to the COB. I'm Andrew Gagan. Great to have you with us here at ausbiz as we close out the week here on this Friday, which is proving to be a positive session. And in fact, it's taking us to a higher spot than we were this time last week, in fact. So today, as you can see, up there, close to 0.5% on the CBA Australia 200 index, which means we're, well, on the ASX 200 at least, we're up around 0.8% for the week. After we did have some precipitous falls in the middle of the week, if you remember that. And that just underscoring the volatility we're seeing in the market now, of course. Sector-wise, well, look, a little mixed, to be honest. Certainly the materials sector with the gold miners once again down. They're up, they're down. That's reflecting on where the gold price is going at the moment, certainly in relation to the US dollar and those bond yields as markets continue to reposition in regards to those interest rates and when the interest rate cuts, I should say, when they're likely to come. Yeah, that's how the majors in the gold sector have performed today. So Evolution, certainly the biggest loser there, off more than 5%. Elsewhere, taking a look at the banks, and look, the headline there was Macquarie Group, which certainly provided a miss as far as its latest result is concerned. A hit, particularly given its commodities division, by lower prices there and volumes. We'll get a little more detail on that in a little moment or two. And the REITs, well, actually, the REITs and also tech, those interest-sensitive stocks, certainly benefiting today, interest rate-sensitive stocks. So Goodman Group leading the gains there, and similarly tech also doing quite well today as well. So it, of course, is all about volatility at the moment, given those central bank moves. What is the next step? Where is inflation going? Earnings results, both here and in the States. There's so much for investors to consider. Now, every month I catch up with Morningstar's chief US market strategist, Dave Sekera, to get his view, their strategy, how they're positioned for the next month and beyond into the rest of the year. I caught up with Dave a little earlier.
No surprises, coming out of the Fed meeting. Unfortunately with the U.S., I think right now we're actually just seeing what I would consider to be, the worst of both worlds. We're seeing slowing economic growth, coming in, below expectations, and inflation, still staying higher than pretty much anybody, ourselves included, really had expected. So we are looking for, GDP to stay relatively slow, over the course of this year. I'd say on a quarterly annualized rate, we're only looking for real GDP in the U.S. to be in that kind of 1 to 1.25% range, through the rest of the year. Now, we do still think that inflation will start to moderate. That's been pushed back. I know we actually increased our inflation forecast for this year, a couple of ticks higher, but our U.S. economics team is still looking at those real-time indicators of rent prices. Again, it's been shelter that's really kept the inflation hotter for longer. Those real-time indicators do show that over the next couple months, that should start helping to help inflation come down. Plus, we should be seeing slower job growth, slower wage growth over the next couple of months as well. So all of that should help bring inflation down. So we are looking for the Fed to cut. But we also push that back. Our U.S. economics team now isn't looking for that first cut in the Fed funds rate, until September.
Nonetheless, Dave, as you highlighted there at the beginning, saying slowing growth, higher inflation. What is the risk of stagflation?
Well, we're not seeing stagflation. We do think that the U.S. economy in our base case will stay out of recession. So again, while it's slow growth, it's still growth. We're not looking for any negative prints in GDP. And while inflation is higher than expected, it's still not anywhere near upper single digit levels or anything like that would really be a stagflationary environment. So not necessarily anything we're that concerned about from kind of that macro point of view.
Dave, equity-wise, you point out that since we last spoke a month ago, the US stock market down some 4.3%. How are you looking at those valuations at the moment?
Yeah, I mean, there's just been a lot that the market had to contend with, over this past month. We've had rising interest rates. The 10-year U.S. Treasury, I think, is up 40 basis points, the higher than expected inflation, and of course, earnings season. And earnings season's been pretty interesting. I actually started off on a good foot, with the banks. I thought the bank numbers were okay, their guidance was okay. With the big tech names, anyone still tied to AI, still coming out, very strong. Although some of the bigger tech names that aren't tied to AI, I am starting to see, some softness and some weakness there, I think, based on that. And then the real economy stocks that we're seeing, most recently, those are getting to be, a little sluggish. So, following that sell-off, the market was at a 3% premium at the end of March. We noted that while that wasn't actually in overvalued territory, we did think it was getting to feel, pretty stretched at that point. So following the sell-off, we are now at a 2% discount to fair value.
Just looking at some of those results, of course, we've just had Apple. What did you make of that, Dave?
Mhm. Well, I'm still waiting for my analyst, to come out with a note, so I can't talk yet to our view as far as what the stock price, may or may not be. But yeah, I think a lot of people were prepared actually for Apple, to have, a relatively, weak quarter. We are seeing that stock up, I think about 6%, after hours right now. When I look at, the sales and EPS came in a little bit above guidance, even though I think iPhone sales came in a little bit light. So I do think right now we're seeing, a bit of a relief rally. A couple things that we are looking for, going forward. I know our analytical team, is expecting, Apple to come out with some new iPads. Those should be announced, next week. And then in June at the developers conference, we are looking for Apple to give, some sort of announcement as far as, really what are their artificial intelligence plans. And then lastly, the other thing too is, Warren Buffett at Berkshire Hathaway does have a very large position in Apple. I'll be listening closely at the annual meeting to see if he's got any comments himself.
All right, of course, that is coming up. Dave, more broadly with the Mag 7, what are the hits and misses that you saw?
Microsoft, beat top line and bottom line. We raised our fair value, just bumped it up 4% to $435 a share. But when I talked to Dan Romanoff, he's our analyst that covers, Microsoft, he just thought results were just impressive from pretty much, all angles. He specifically called out Azure, its cloud business is doing, exceptionally well. Looking at fiscal year 2025 guidance, that's pretty consistent with our model. I still think that, Microsoft at a 9% discount, even though it's a 3-star rated stock, is really a core holding, type of stock. Taking a look at Alphabet, they beat big, both on the top line and the bottom line, hitting on all cylinders there. They did announce a stock buyback, and a dividend. So I do think the market, is liking what they're seeing right there. Bumped up our fair value by 5% to $179, a share. Also an 8% discount to fair value, probably another core name. And then lastly would be Amazon. So they beat on top and bottom line. Their revenue guidance, I think, was a little bit lower than what we were expecting. However, when we look at, the demand for their cloud business for Amazon Web Services, we model in some additional cost savings. We actually bumped up our fair value there by 4% to $193 a share. So I think that one's trading at about a 7% discount as well.
Dave, sector-wise, I think we've got a chart, in fact, just in terms of valuations. What are you seeing in terms of outperformance and underperformance at the moment?
Yeah, so real estate is still the sector that we think is most undervalued. It's also the sector that got hit the hardest last month. I think it was down 8% last month. So when we look at real estate, it's now trading at a 17% discount to our fair value. See a lot of great opportunities. Now, still, I would steer clear of the urban office space. I think that's an area that probably still has, some downward valuation pressure there. But the more defensive areas in real estate, whether that's healthcare, triple net lessors, or even like the self-storage, guys, I think they're all very attractive at this point. Communication services at an 8% discount. A lot of that is going to be Alphabet trading at a discount, but a lot of more traditional names like AT&T and Verizon, also still at attractive discounts. And then basic materials at a 6% discount. And specifically within basic materials, I still like the gold miners. I think we talked about that last month, seeing some good numbers, coming out of the gold miners. And what I really like there is we actually have a bearish view on the price of gold. Over the long term, we think gold prices come down. But even with that bearish view, I think the miners are all very undervalued today.
Yeah, they've certainly lagged that gold price to date, haven't they? Interesting then, Dave. Tech, how are you seeing that perform then?
So tech got hit, pretty hard in April. It was the second most overvalued sector, coming into the month last month. It's now down enough, and then a couple of fair value increases, here and there, has now brought it towards fair value. It's trading at 1x our fair value estimate right now. So it's a good time now to move back into more of a market neutral position or market weight in tech. We were underweight in tech. So a lot of names there. I think it's really starting to see a little bit of bifurcation between the AI and the non-AI names there. So definitely going to be a stock picker's market.
And lastly, and just briefly, energy. How are you viewing that at the moment? I guess particularly given geopolitical risks have eased to a degree.
They have, but I still think energy provides a really good natural hedge in your portfolio. A lot of the energy names, have, come up a bit. It's only trading at a 3% discount, to our fair value. It was much more undervalued at the beginning of the year, but we're still seeing, some good discounts and some relatively solid names. Exxon is still, our pick among the global majors, trading at, a bit of a discount to fair value. And again, if inflation does stay higher for longer, I think it provides a good natural hedge against that as well.
That is Dave Sekera, Morningstar's Chief US Market Strategist. All right, well, let's get into the three themes as we round out the end of the week here. And, well, we're ending on a week high. Certainly looking as though on the ASX 200 we're up about 0.8% for the week. Macquarie missed. Well, it did. Just in terms of its result, it has come off today on the local market as a result. Clearly one of the biggest companies on the ASX and closely watched. And Block, its Bitcoin bet, doing well there. Certainly off results in the States, particularly in terms of its Afterpay business as well. In fact, let's get some greater detail on that into the corporate stories that are making headlines. And checking in on Block, its shares, as you can see, up almost 10%. The Afterpay owner planning to put 10% of profit generated from Bitcoin products into purchases of Bitcoin itself. Telix Pharmaceuticals, it's completed the $50 million acquisition of a US-based biosciences firm and its investigational drug which targets bone cancer. The deal, which was based on cash and shares, will see investors of QSAM Biosciences receive Telix shares and $7.57. And Macquarie's full year net profit fell 32% off the back of weaker performance across its commodities, global markets and asset management businesses. Weakness in Australian M&A activity and lower asset realisations in green investments impacted Macquarie's bottom line in fiscal 24. All right, well, to sum up the week as we do, we welcome Shane Oliver from AMP. Shane, terrific to catch up with you. Haven't spoken to you for a while. Good to see you again. Let's start first with what you're seeing on the equity market. We're up, we're down. That volatility continued. Do you think it's likely to continue throughout the year? I was looking at your note and you're calling it messy. Why is that, do you think?
Well, look, the reality is we did have a very strong run-up into March, obviously more so globally with tech stocks buoying the US market, but we also had a pretty good start to the year, very strong run out of that low in October. And of course, that was all on the back of expectations for rate cuts and a very soft landing in the economy. And I think it totally ignored the geopolitical risks that are around. I still think rate cuts are on the way, but obviously they're going to be delayed. That's a bit messy. There's uncertainty around that. There's obvious uncertainty about the growth outlook. In Australia, growth is quite subdued. Globally, in the US, it's strong. Elsewhere, it's a bit subdued. But there are signs that the US economy is slowing down and there's still a recession risk there. And on top of all of this, you've got the geopolitical risk factors that we've talked about endlessly, but markets, until recently, haven't been too concerned about. So I think that's going to give a messier ride, more constrained, more volatile. Ultimately, I think the year will end okay. As central banks do cut interest rates, but I think it's just going to be a more volatile, more constrained ride.
In fact, Shane, overnight we had the OECD update its forecast for the global economy, certainly seeing continued strength there in the US, a little weakness emerging certainly continuation say in Japan and Europe. Overall though, has upped its forecasts. What did you make of that? Is it sort of in line with what you're seeing?
Yeah, I think it's reflecting, what the IMF told us a couple of weeks back. I think they increased their forecast as well from 3.1 to 3.2 or something like that. And it's sort of in the range that it's been in the pre-COVID period, just above 3%. So nothing unusual. But markets largely factored that in, partly given that rally we had coming out of October. So as always, share markets had moved ahead of that. And we're aware that the growth outlook had somewhat improved. I guess the concern, there's a couple of issues around that. One is as the growth outlook improved, particularly in the US, it then started to, you could argue it was getting so good that it then creates worries about, well, maybe interest rates will have to go up again, particularly given those stronger inflation numbers we've got. But recently, the data out of the US has started to slow again, which I think is probably a good sign. But to be honest with you, I don't think there are any great surprises in what the IMF and more recently the OECD have put out.
In fact, Shane, I was just talking to Dave Sekera, the Morningstar chief market strategist there in the US, and he was saying, look, there are some negatives there given slowing growth plus persistent inflation. And I asked him, what's the risk of stagflation? They don't see it. Do you think that risk is there?
Oh, look, it's there, but I think it will only be momentary. There is a reality in the economic cycle that inflation lags economic growth. So, inflation's often sort of at its high point or still high at a time when growth starts to slow. Eventually, the slower economic growth feeds through to lower inflation. I think that's what we will see in the US. So it's just a point in the cycle. I don't think it's a sort of going to be a 1970s style stagflation where we went through a 10-year period where economic growth was relatively subdued below what you'd regard as the normal potential, and at the same time you had high inflation. I don't think we're going to go into that. If we are going to go into that, then that would be a major worry because the 1970s were bad for both shares and bonds. Best place to be was I think gold was a good place to be, or property. Property maybe not so good this time around given all the debt that underpins a lot of property. So, from today's vantage point of view, cash might be a better investment than shares or bonds if you believe stagflation is going to remain. But I don't think it will. I think it's just a brief point in the cycle, and ultimately slower growth will give way to lower inflation and lower interest rates.
And Shane, what did you make of what was the wash up from the Fed, in particular the commentary coming from Jerome Powell?
Look, to be honest with you, I thought it was, it was fairly balanced. Powell didn't say anything new on the hawkish side. He'd already indicated that the inflation numbers had been disappointing through the March quarter and it's going to take longer to cut interest rates, and other Fed officials had said the same thing. So there was nothing new on that front. And then he was asked, and he made comments to the effect that he didn't expect interest rates would rise. He still saw inflation coming down, was optimistic that America's seeing a supply side pickup, which will help as well. So those things, I think, were probably better than most were fearing. And that's why shares generally have bounced since. Now, of course, you saw a lot of volatility. The US share market initially went up on Powell's comments, then it came down again. So that was a bit messy. But if you look across the 2 days, overnight, US share market went back up again. It's consistent with, I think, fairly benign comments from Powell relative to what might have been feared.
Yep.
But there is still a reality there that rate cuts have been delayed in the US. The market consensus is the first cut won't come till September now, whereas earlier this year the money markets were talking about March being.
And Shane, locally, what are you seeing with the Australian economy? Certainly some speculation that the next move from the RBA could be a hike. Certainly the market's now sort of pretty much pricing out a cut this year. What are your thoughts, and what do you think we're going to hear from Michelle Bullock on Tuesday?
I must admit, to some degree, it reminds me of the period from 2011 to 2020 or 2021, where continuously you had consensus of economists and money markets saying, well, the next move is going to be up. And then lo and behold, the next move was actually down. And now we're seeing the reverse of that. So maybe, interest rates do have to keep going higher. Then I sort of think, well, it is a bit different today. Household debt levels are much higher. We're already seeing weakness in consumers. Consumer spending looks to me like it's stalled. Yes, we did see some higher than expected March quarter inflation numbers, but I'm also conscious the September quarter surprised on the upside, the December quarter surprised on the downside. March is now on the upside. Continue that pattern, we'll probably see a downside surprise with the June quarter inflation numbers. So I kind of think that the best approach for the RBA is to wait and see. It is clear from the consumer spending figures out today and on Tuesday for retail sales that the consumer is still under pressure or under the pump, as the Treasurer likes to tell us regularly. And therefore, I don't see a need for the RBA to hike. There's also a little bit of a problem there that the factors that are pushing inflation up in Australia somewhat beyond the normal control of the RBA. Insurance costs, rents, education costs, and so on. They're all either connected to government or they're connected to disasters, bad weather in the case of insurance. And so there's not much you can do about that. And if you keep tightening too much, there's an argument, you've got to keep tightening maybe to keep inflation expectations down. But beyond that, the risk is you end up just ending up with a recession. And price pressures in those sectors still remain. So that makes it a little bit more difficult for the RBA. But on balance, I think on Tuesday they'll leave rates on hold. They'll probably move to some sort of tightening bias, saying maybe they can't rule out another hike, or alternatively saying they may have to hike again, exercising a bit of jawboning. But I think ultimately they won't hike again, whether on Tuesday or in subsequent months, and rate cuts are still in the cards, but it's probably later this year, maybe around November, December period.
All right, and then of course the week after that we've got the budget and those looming July tax cuts at the same time. I guess some question as to whether they're going to be inflationary at all, given some of the measures that the government has in mind.
That's right. The budget's going to be interesting in a way because of the Future Made in Australia stimulus. Hopefully that's offset by other savings and it doesn't add to inflation.
Plenty to consider. Shane, terrific to wrap the week with you as we do always. Thanks so much for joining us on AMP. Have a great weekend.
Thanks, Andrew. Take care.
All right, let's now get to the stock of the day. No surprises. Macquarie Group, I should say, given its result, which was a miss, full year net profit falling 32%. So let's get some analysis of that, and Adam Dawes from Shaw & Partners and Junbei Liu from Tribeca Investment Partners for their take.
Cycling the capital, particularly in the renewable space, they're actually making really good progress, and that will establish the foundation for the profit growth for the next following many years to come. They establish many funds with the industry super fund and the like, so they can recycle a lot of those capital into it. So I think it's pretty good. A really good entry price. The result itself is nothing to really worry about anything else.
Okay, so that's a buy?
It's a buy, yeah.
Started to see the M&A activity here in Australia, but overseas we're seeing corporate actions as well. We're seeing a lot of activity. Macquarie will be very active in that space as well. So I think overall, the green investments was probably obviously one of the bigger things that dragged them down, and that's been pretty tough in a lot of the sectors in our market as well. So yeah, really comfortable with Macquarie. $180 would be my buy price for that.
All right, well, as we were talking about with Shane, there's lots to consider next week on the calendar. Locally, of course, headlined by the RBA policy meeting. Going to be fascinating to see, particularly the commentary coming from Michelle Bullock on Tuesday. Also get some important data there, including retail sales, and read on UK employment growth, as well as the BOE meeting as well. And a little more there too in terms of US services PMI. And the key tonight will be that non-farm payrolls data. All right, let's get into the performance today. Those who have been led by Block, in fact, up almost 10%. Helios also doing well. The uranium miners back in the green, led by Paladin there. And in terms of those that are lagging the markets, let's take a look at that list. No, I don't think we have that list, in fact. Oh, here we go. Yes, Evolution Mining. Yes, some of the goldies are coming off today. The gold price did come off a tad overnight, but Evolution being hit hard. Bellevue Gold also in that bucket, and Insignia Financial also after having gained earlier. In terms of the small caps, Vinyl, it's up 15%. Gold, hydrogen, and Anson Resources, so a number of resources stocks there. And in terms of the laggards in that space, Ardea Resources, St Barbara, the gold miner, and also in the pharma space, Race Oncology. All right, so this is where we're at, let's call it 0.5% higher on the CBO Australia 200 index. We're up around 0.8% for the week. All right, and that is the COB. Stay with us because the last call is up next.
The COB is brought to you by Pepperstone, trusted by traders in over 160 countries.
Gil.
Oh, hey, Ken.
Here we go.
You still trading?
Pepperstone. Trusted in over 160 countries. You?
Well, I'm still with...
I don't think anyone trusts them.
No, I'm fine with it. Just like I'm fine with my trusty coach. 1980s John McEnroe.
Pathetic! Horrible! 1980s, huh? So, really temperamental?
Keeps me on my toes.
Awful! It's a bit intense.
Be better!
Still fine with it.
Use your racket!
He's just staring at us.
Yeah, sometimes he yells and then sometimes he just stares.
Is he aiming for your face, Gil?
He's fine with it!
Yeah, he's definitely trying to hit you.
Fine with it.
Don't be fine with it. Switch to Pepperstone, trusted by traders in over 160 countries.
Come on, you cannot be serious!
Don't do that.
Ow.